Powell is going to get us back into QE. You don't think so? Listen to this. This is nuts. This was yesterday.
As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets.
Oh, really? We did that in 2008. Remember? And they said the same thing. Bernanke in Obama said we're only going to do it for about 90 days, 30 to 90 days. And it went from 2008 to 2012. And what did Powell have to do finally here? He had to get a lot of that money out of the system. He had to pull $2 trillion out of the system because he kept increasing the money supply. Everybody kept increasing the money supply. So he had to pull that money out. And that's what he did for the last 2 years. He pulled out about $2 trillion doing QT, just the reverse. So what he's saying right now, he's going to go back to QE. But he's not going to call it QE. You watch. They're going to change the name. They're not going to call it QE. Because, remember, they couldn't get inflation down to their target of 2%. It's a 3%. So by lowering rates, again, like we did in 2008, it's going to get worse. Now, what's happening is the banks in 2008 collapsed. Well, they're not collapsing now because of repo agreements, repurchase agreements. Now, people are asking me left and right, why is it that the banks continue to rally when they have $600 billion in losses? Well, you got to understand those aren't recognized losses yet. Okay, they're not recognized. They're unrealized. Why? Because what they've done is, as long as their revenue is still good, as long as their revenue is coming in, and as long as they got enough revenue to make sure they maintain their reserves by law from the Fed, let's say you have a reserve of 10 million. As long as they maintain that and you got money coming in, they're maintaining the reserve, they don't have to count that as a loss yet. It's unrealized. But here's what goes on. While everything looks good on the surface, underneath, what are you seeing? You're starting to see a slow erosion of the reserves. And once the reserves start going down from where they're supposed to be, I mean, it's a law, it's legal, it's got to be there. Once it goes down, what do? They're going to start selling all of these treasuries that they purchased at 2.3%. And when they purchased those at 2.3% and interest rates were near zero, they never thought inflation would go up. Well, guess what happened? Inflation went up to 9%. And they bought these at 2.3%. Powell comes in to fight the 9% inflation. He raises rates to 5% to fight the 9%. And all these banks have bought all these treasuries, trillions of dollars worth of treasuries at 2.3% fixed. So they're losing between 2.3% and the 5%. Now, remember, these losses have not been realized. I just said a moment ago. Now, they don't have to be realized until they're at the point where all of a sudden you start seeing car payments are late. You start seeing mortgages are late. You start seeing all that coming in. Then what happens is that income, the money that's coming in, starts to go down. That pokes down the reserves. And once you get below that legal reserve line, you got to start selling those treasuries that you're taking a big loss. Now you got to take that loss. Now they become realized. So right now, everything's fine. It's not happening, but underneath, you can hear it, you can see it, you can smell it. We're starting to see our reserves decline because of all the problems that the banks. Matter of fact, one thing you always look at, want to know if banks are going to be in trouble, you always look at, every pro does this, they always look at the car payments. The car payment, they will not give up their car. They got to get to work. But when you see the car payment foreclosures, where people are losing their cars, bringing them back to dealers, and when you see that climbing and climbing and climbing, that's when the banks are going to be in trouble because they don't have enough money coming in to hold those reserves, those capital reserves, and they have to sell all those that are lost, all those treasuries that are lost, and that's when they have to classify it now from unrealized to realized. That's what's going on. That's what's going on. One thing you got to watch. Now, we own banks, and we still own them, but we have the skills to go short when that occurs, so it doesn't bother us. Now, the other big problem nobody's talking about is the fact that the corporations who, for all these years, buying stock buybacks, they've been borrowing money at 0% interest from the Fed. And they take that money and they go buy their own shares back. Because when you reduce the amount of shares you own, earnings go up and they push your stock price up and you don't have to do a thing. You don't have to increase sales, you don't have to do anything. It used to be a felony. You used to go to jail for that. So that's what they've been doing. But right now, we're starting to see exactly what I just said a moment ago. All these cars, all the repossessions, application denials are increasing, mortgage refi. If you go get a mortgage refi, don't feel upset if you get the denial, because they're up 46%. Denials are up 46%. That's the problem. So corporations are going to get hit hard because these corporations now have to pay 5 to 8% on $14 trillion in debt. That's one of the big problems. So I always tell my gang members, it doesn't matter to us one way or the other what the market's doing, because we have the skill to buy, but we have that other little special tool, how to sell short. So it really doesn't make any difference. You should be in that position too. We'll show you how. philsgang.com.